All right, I'm starting. Now, I have the questions tab open and I'm going to go just pretty much in order. If you have additional questions, then you can leave them there and I'll get to it. So we'll just go ahead and start that way. And then maybe at the end, I'll just talk about what happened today as well. Okay, so Max Sydney says, what are your thoughts on moving into more liquid markets when trading smaller account size? Point of view on highest leverage activity. Okay, so these are all separate questions. I'll just answer one by one. So I pointed out, and there is like a tweet in the general tab. I have like a content Brian only tab. One of the tweets that I think is really important in there is that if you have a smaller size account, it is completely fine to trade more so illiquid stocks. I'm not saying like the ones where you move market, that is really bad, by the way, and they will flag you at the brokers thinking you're doing something weird. But I'm just talking like, let's say in pre-market or something like that, there's just a small amount of volume. If you can move in and out of those trades, there's nothing wrong with taking those trades. If you have more edge as a smaller account, and larger traders won't touch that. Now, there's a point at which nobody should be trading in a liquid stock, which is when you'll see the prices sort of skipping, the spreads are just extremely wide, or like the volume is very sporadic, if not sometimes just printing no volume in like a minute. You still want to see like a pretty average amount of volume, because the risk component is that if you're trading something liquid, you could have a position, feel comfortable, but like maybe in another couple minutes it will just swipe one way or the other, and your risk is very like difficult to kind of mitigate at that point. So I'd be very careful. I'm just saying, like, some in the past I'd look at, okay, this candle is trading like 50k volume and I need 100,000 shares, something like that. Like you never want to really be a majority of any volume candle, because even if you can size in, the problem is like, this is just my theory, but I also think it's pretty accurate, which is like a lot of times when you're interacting with the market, especially when it's like very liquid, your counterparty is mostly market makers. So if you just think about it, like you're trying to put on size onto something where there's no one buying it, like you're shorting it, you can cause like a short-term kind of weakness, like even a pull, and you'll think you're right. But that's just them giving you inventory, and then the point of a market maker is to make money on their position. So a lot of times they can simply push it back up to the point where now they're in the money and you're also down, and just kind of recycle into you. And they're, the way they make money is a lot more tighter than like how we make money. They're willing to kind of bully the market around and also, take smaller gains. So it's just not something you want to do. Like my experience of trading even like somewhat liquid stocks that appear to be illiquid at the moment is any sort of short-term price movement that you cause yourself will almost invariably come straight back within a couple of minutes, unless like that. And that's only something that you can really take advantage of if you're just gonna take your position off like into the next kind of flush or whatever, and even then it's not guaranteed. So those trades are just really dangerous in general. Point of view on highest leverage activity someone can take. So the misconception about like risking 1-2% of your account is that you are not utilizing like leverage, right? And people will say like, okay, well, this is my A setup and I'm going to put my whole, or not my whole account, but I'm going to put a lot of margin into it and buying power. But the thing is there's plenty of days, like if there's a hot market and there's a lot of opportunities and you're also kind of pyramiding into positions, there's been many days I've simply run out of buying power. And it also really depends on what you're trading as well, because in case you're trading like larger caps or mid caps, and even actually in the smaller dollar range tickers, like if you trade something under 250, a lot of times the brokers have to give you like, they have to account for much more margin and buying power. So those tickers, even though you're trading like a smaller market value, will be counted at a much higher rate, and so you can run out of buying power in those situations, as well as and for some people who swing, like that can also affect your buying power. So like, yeah, I think the highest leverage is literally your whole account. It doesn't really matter how much money you have in the market. It really depends mostly on what you stand to lose, and obviously you can build a bigger position based on how close your risk is to your entry. And just in a lot of cases, like, don't expect just because you're risking a small amount of your capital doesn't mean that you won't be utilizing your account to the fullest potential. So that is a very common misconception. Your current bottlenecks to progression, what you're doing about them. Currently, bottlenecks mostly market. It's mostly determined by market. This is a weird question just because I've been trading so long. Like, I know what's abnormal, and I can say like the last couple months has been very abnormal. It makes some people look like heroes if you're trading like a smaller time frame, because like for example, you can nail the bottom on like one or two flushes, but like a normal activity would have been 3 or 4 flushes. So like I said in the last kind of webinar, it's like people trading on a smaller time frame will make money right now, and they look like geniuses, but in a good market they will miss out on a fortune. So it's really just about that. And I am more in the process of just saving mental capital and adjusting my strategy to compensate for shallower movements and more aggressive front side. So again, I mentioned in my Friendly Bear podcast, is just trading a little more safely on strategy. Like I'm definitely way more on the backside than I would be typically on the front side in the past, because that risk is not really justified in this environment. And for that, it's just really understanding the nuances of that new system and how that trading works out. Sometimes it's surprising to see like, okay, well, if I traded the front side, yeah, I could have got a higher average, but like the risk that you're putting on not paying out can equal kind of a safer entry with a lower risk reward and a higher win rate. So it's really just a balance of these things that traditionally I've not been forced into, whereas like nowadays that's kind of what I'm doing. Okay, Jackson says, Brian, you said in your Traders for Cost speech on systematized risk that you almost broke down due to being set at a frozen R for so long. Broke down. I'm not sure what you mean. What I was saying. Yeah, this question, I don't know exactly what you mean, but essentially what happened is that I was risking like 2% of my account, which I think is very aggressive actually if you're not a consistent trader. It doesn't sound like a lot, but like literally if you have a couple of 3-4 hour gains on a day, like you can really skip very quickly. And that caused me to, let's say you compound that by breaking a rule. So now you have like increase your exposure. Maybe you didn't obey your max loss. It comes down, you make a ton of money, and you say, well, I should be going 2% of my account, and I just made like 30 times more than I would normally make, or whatever. And so you're risking that now, and then all of a sudden you have no fucking clue how to trade that. Like your emotions are all fucked up, and that's probably one of the worst places to be in terms of risk, is just like way too far above your tolerance. And so that's why freezing is very important, and that's why I implemented that rule. So like no matter how like impressive a day may be on all-time highs, like peak size, You never go past your threshold for what you deem to be meaningful to you that will impact your decision making. And in reality, like most trades you take, you should not really feel the effect of a loss. So until you're not afraid to lose, it's wise to kind of just hold on to the risk level that you have or something nearby that is significant. Casey says, I've been consistently making small gains but struggle to trade in R. I usually use wide stops and continue to add to my outer lines, but when it breaches, I take a full loss. And if it rejects before I get in with maybe 20-50% of my full R. So this comes down to pretty much one of the discussions that I posted about scaling on the super follower feed. And essentially the point is that for most beginner traders, you're going to see like lots of traders influences scaling into trades. And in my opinion, scaling into a trade is almost the same as just guessing. And it means there's a lot of room to be desired in terms of your system. Scaling in has a lot of benefits in terms of like, if you want to have like a smaller amount of exposure when you're not sure of the trade, like front side, or the trade hasn't necessarily like confirmed a top or a trend or anything like that. And for that reason, you can use it. And you could also say like, okay, well, my max like kind of risk level would be, you know, a little bit further than where the price is right now. So I'm willing to kind of like add into even a loser, which is not technically a loser as long as you understand what your ultimate like dollar risk would be at that level and you can position size properly. But the problem I find with this is that it's just very complicated for a lot of newer traders. And I think that you would benefit a lot more from putting the bulk of your position on in one or two shots. And, you know, you can pretty much just do a gut check and say like, okay, on my trades in general, do I typically have the best entry on the first one or maybe the second attempt? And you can kind of skew your position sizing to, you know, kind of match the impact or the quality of those initial entries. And you could say, okay, I'm going to put like a quarter on the first one, 3/4 on the second one, half. You know, you want to make it very easy and you want to make it very kind of like programmable in a sense. Like you can put it into Excel, you can have kind of your position size calculator that will have those preset ratios already set up for you so that once you input your prices, you know, you'll be able to instantly identify what your new risk is, what your average is. You know, it's very simple. So that, to me, that's more effective like at the beginning. Like I mentioned, it's like if you don't have a baseline ability to be profitable, then scaling only really skews your results much more. And in fact, if you watch kind of Lance's last video that he did with SMB, he speaks to this concept of expected value as the trade goes on. And you can see like in his example, you know, even if something is more confirmed or whatever, like you're actually, you know, not standing to make more in the long run from those trades. So it's in my opinion, it's much better to just get in the habit of putting on your position in full most of the time. And again, like if it's, I would revisit that thread, number one. And then number two, if this is something that you can't execute at the moment, then again, it leaves something to be desired. You need to really analyze what you're doing. Try to be a little more accurate in terms of your, you know, systematization of the entry. And until you can really define that and bring something into the market to test, you are probably not as good as you think you are in terms of the entry. That's just the simple truth. So that's really where what kind of direction you want to go for. And, you know, sometimes people will say like, okay, Brian, if I put on half of my risk and it went 3R off that risk, do I say it's 3R? And I say no, because like I literally intend to be full size every time. And sometimes if that means I have to kind of add into a position at a random spot, then so be it. But for me, there's no trade worth taking where I'm not going to want to be full sized. And, you know, the more you hesitate, the more the market goes against you, the more confirmation you need, the more you're going to be basically hitting tops if you're buying and shorting the bottoms if you're short. And, you know, stocks, they move up and down and you're going to get chopped up. And that's a really horrible kind of feeling to be in. Whereas like you you define your risks, you have your entry. Now you're kind of in trade management mode versus like a frantic kind of analysis of a market, ongoing rolling. It's just like if you notice, like for me, a lot of things I will tend to say are, let's make these decisions very efficient so that we can focus on what needs to be done, which is the risk management of a trade. And in terms of like optimizing the trade for adding scaling into winners, this is something, again, you have to create enough experience for yourself to the point where, like, once you start adding, you're gonna start losing win rate dramatically. You may increase your wins, but you also might offset that by losing a little bit too much, and that can turn a profitable strategy into an unprofitable one. So you have to be really careful about that. And a lot of times, like, you'll test something, an idea, it won't work. You have to be able to have a confidence, say, like, I've been doing something consistently for the past 3-6 months, and I know, like, I can go back to that. And you should kind of like, this is part of the reason why I love Google Sheets in general, like more than Excel. And I don't know if Excel does this, but Google Sheets, you can literally go back in time for the version history, and you can pull up exactly what you're doing, so in case you lost it. But at the same time, I also kind of like, whenever I make any tweaks or anything, I kind of just take the existing like page or the calculators I'm using, and I just kind of like move them to another section of the sheet so that I understand, like, if I need to revert, I can do that very quickly. So this is kind of a process. Adding to winners is very much an advanced concept, and you can take it way too far as well as a newbie. Scaling in without putting on your size, it's just a very kind of poor way to be taught how to trade, in my opinion. It lacks a lot of accuracy, and when you lack accuracy, oh Jesus, sorry. When you lack accuracy, it's going to be difficult for you to kind of like manage risk when the time comes, because you always feel like loose. You feel very loose about like where you put the positions on, where you take it off, etc. And it's a very bad habit. Okay, so I've been consistently making small gains. I did that one already. The idea of flow rotation confuses me because lots of gurus say more flow rotation, more lane stores alongside. I don't even really need to read that whole question. I just say, like, flow rotation is a very overrated concept. It may have been more important 2 years ago when the volume was in like 500 million a day as normal. So in the past, we could see just a couple million in a day. And if something's trading 50 million volume, you don't even need to be really cognizant of flow rotation. I almost never felt like it was important. I feel like the most important factor was just the float itself, and not only just what you're seeing and reading. It's how the level 2 feels. So you should pretty much have the level 2 open on whatever stock you're watching, and look at those spreads. Look at the bid and ask. Look how much size there is just by default. Look at how quickly the stock can move, because you can see sometimes like a larger float, but the stock moves very aggressively, very swiftly. And so in those situations, I tend to be a lot more careful and not as eager to put on a tighter risk. And you have to just be cognizant of that more than anything. The flow rotation, in my opinion, hardly plays a factor, and it's just a waste of mental energy. I asked previously if you always risk 1% max R on a given trade. You said most of the time, yeah, but you have one extra trick. Okay. So, yes, it's a more advanced strategy, which is why I hesitate to bring it up, but I'll say it just so you can keep it in mind, which is that there are certain situations where you may be able to risk like an extra R, but you have to be really careful, because this can really destroy your profitability in a big way. And I will say I've done a lot of experimentation, like sometimes risk 3, 4R, whatever, risk the same stop level, not reducing the stop, whatever. And I will say, like, it's very stressful and it sucks. Like, if you look back at some of the like older, like, I mean, this is for really OG people, but back when I was like posting a lot about my months and stuff like that, you could see that I would constantly say like I over optimize it. It's not, like I am still trading like a 3-to-1, 4-to-1 level, but the risk is higher. It's like when all that's matters when all said and done is the averages. So it's like, yeah, if you make 10R, right, then that's cool. But if you risk 3R to do it, then you're still trading on a profitability curve of a 3, like a little over 3-to-1 ratio. And so it's like, that's only going to get you so far. And in fact, like, it's basically just cheating. You're basically signaling like, I'm not willing to face the fact that I'm risking that much. So it's like, you didn't come into the day risking that as 1R. You came in risking a much smaller R, and then you kind of like found a way to gain like a huge advantage. But the thing is, if you just do the math and you just look at the truth, it's like at the end of the day, it's going to be a ratio, and that ratio is ultimately what matters for being profitable. And in trading, you're looking for that like 100 to like, many hundreds of samples playing out an edge over time. And like, really, it's just there to kind of satisfy your need to make more and desire to make more. But that can hamstring you when you push it too quickly and you're just out of sync really with your risk management. And so like that can have a really negative effect on you. So I would say like pretty much like towards the middle of this year, I said like, I'm going to just go back to what worked for me in the past, and like taking 1R losses, things like that. It's the best feeling, and it's, in my opinion, it just feels that that's the correct thing to do. You can manage your risk more effectively. You can set your risk parameters more effectively. You're being very honest with yourself, and you're being honest with others. Like, it's just, there's no way to really manipulate that. And everything that I talk about in terms of like, you can lose over 100 times in a row. You can like give yourself a 3R position loss on a trade. If it's like then you legitimately will take 3 full trades of losses. Whereas like you say, I'm going to risk 2R and you have a 3R position loss, and yeah, you might have 2 tries instead of 3, and then you'll take even an additional R of loss if not being slipped or making a mistake. So like at the end of the day, if you want to risk more, you need to be having the balls to come in and be honest with yourself. I'm risking 3%, 2% today. There's no 2R loss, 3R loss. That's just kind of bullshit that we all maybe teach ourselves. When you pull up a chart and your default chart, set up loads, what indicators, what timeframes are there. So I typically look at a 1-minute chart, and then I kind of have like so up here in my TOS, you can see I have like these 3 bars. And so actually, for the recording, you'll see this, guys. So I'm just going to go over it real quickly. So pretty much on TOS on the top right, there's like these squares, and you can set a grid layout where you can kind of cycle between different time frames. So I have a 1 5-minute and daily, and that's basically how I'm going to start my technical analysis. But since the people live can't see it right now, I'm just going to leave it at that. I think you guys can look that up as well. In terms of indicators, obviously I have like my full loadout. That in a sense is somewhat proprietary, but like if I loaded up a chart, it would have the indicators corresponding with that time frame. It would have labels that are basically telling me points of interest, position sizing, like potential price target, risk levels. My bars would sometimes change colors based on if anything triggered. I'd have like chart bubbles that contain text that I wrote myself. I would have Like an example of that would just be a chart bubble that says like add this price, just mostly for my own use, and then I have like time of day kind of like posted up on my chart so I can see. Like sometimes I'm not paying attention, but then I'll see like a huge kind of indicator that will tell me like, okay, it's like this is a significant time for you. Don't scan anymore. Don't add anymore. Or market's gonna close, etc. Like these are things that I like to see because they are in sync with my process, and I recommend like you really get into kind of the nitty gritty of code. And the way to kind of do that is basically just copy the code. I literally just copy the code. You can like, there's a lot of Futures.io code available. You have, code within the platforms themselves, and you can kind of like just create a duplicate, figure out what areas you can kind of edit, quick edits. Just like, okay, it says 5-minute moving average, let me change it to 10-minute, or it says dashes, let me change it to a line, let's make it thicker, etc. Like you just basically need to learn kind of the basic syntax, and you can do a lot really like with very basic knowledge. And I think that's really critical for like really taking your system to the next level, in which you can kind of like see your thought process being kind of like painted onto the chart as you're like trading real time. And so the decision making process is a lot more quicker and also visual. So like some things may be bigger, bolder. Like if I want something to catch my attention, I will maybe have it like a cyan color. Stands out very much, or like a very muted color. If I want to, something's more of short signal, it might be red, buy signal, green, etc. Like really just think about all these different UI kind of optimizations that you can make for yourself. And this is kind of just like a lifelong process where you just always changing it. And I'm always changing it. I actually used to have quite a bit up, and I stripped it down. I know people like to say like, oh, you don't need all this stuff, and simpler the better. But I can tell you like almost all of the information I'm seeing on my screen is like very relevant, and there's a lot. And sometimes it's just good to like know exact numbers and not have to guess. Just for example, like if your signal triggers on a price, like to me, I want to know what that price is. And so I'll just code that in, and like I remember I talk about sometimes building in failure. So I'll kind of like show that price and I'll code it to be printing the lowest value of a candle. So I know that when I backtest it, if I would take that signal and I input the very shittiest entry possible, would I still maintain a good trade? And if that's possible, then I can only outperform this signal. Whereas like sometimes people, they give themselves too much credit, and that can really affect your results, because like when it comes to expectations in the market, you really just want to like pretend you're just the shittiest trader you can be. And whereas if you want to be a perfect trader, then you only have doubts and negative feedback from that. How do you calculate historical resistance, price to short, to use VWAP of the day, to use top of candle? Okay, so I know like you specifically or have studied DUX, and I think we talk about a little bit, but basically these concepts like VWAP Boulevard, ADF, DUX, they use this. They've been a lot more inconsistent lately, and it's not something you can really put all your money behind or like claim it has like a super omega win rate. They're just kind of areas of interest that you should note. And so whenever I'm like looking at resistances, I'm mostly looking for like, I'm looking at areas that people are looking at, and the VWAPs do come into play. So I'm looking at like, if it's a multi-day, is there like a breakout level? If there was a high volume day, whether it's above or below, like where was the VWAP of that day? So I know like who I'm trading against, what the positions might be. And so like if there's, like 100 million volume day the prior day and we're trading above that price, like, on the current day that you're trading in, you're trying to short it, that can be very dangerous unless that kind of previous day was triggered by some kind of short squeeze, something that's not sustainable. If it was like really like churning and trending this way, the odds go a lot lower. And as well as like, there's a lot of kind of traders who are just targeting the breakouts and points where shorts are getting squeezed out, and sometimes even they'll go long and try to create that kind of movement. So it's like you just have to be wary of like setting hard lines in the sand in terms of resistance. I think what's more indicative of kind of like where resistances may be, it has to do a lot more with like price action. So you want to see kind of like a break of trend. You want to see like pullbacks. And in fact, like, I know some people, they want to top tick everything, but when you top tick, you may pick a resistance as your risk, but that might not even be a resistance come time for it to like spike through. So it's easier to kind of say like, okay, we're seeing supply coming in. The chart's pulling back. Now, if I'm entering, I have a level to risk off of, and that is going to be much more helpful than kind of looking at the daily chart and just like guessing resistance levels. That being said, there are levels on the daily chart that do come into play, and you do want to always do your technical analysis on these daily charts because, occasionally there'll be a factor that you don't see on the intraday, and by kind of labeling it or making a like a line or whatever on the daily chart, you'll be able to see that on your intraday chart. And I recommend kind of like creating like a color coding system of the lines. So for me, some lines, they'll be different colors and I'll know exactly what that means. Like I'll use pink for VWAP, for example. So it's like if I see a pink line, there's no question what I'm seeing. And so like this is definitely, it's not something to miss out on, but it's also not something to like overly weigh your trading odds on, because like chances are if you're keeping an eye on it, other people are also keeping an eye on it. And a lot of times when it comes to those points on charts, like high of day or whatever, like a lot of times people would just blow through that or just try to brute force it. And that could cause you to just take a loss for like not no reason, but in a kind of a frustrating way. Because, we've seen a lot of times stocks, sometimes they just go 1 cent over the high of day and then they slam back down and you literally have no opportunity to get back in. So that kind of stuff really sucks. But it's part of the game. Okay. And, of course, sometimes people, they want to just jump the gun and be like, okay, I'm going to short all the time. Breaks out. And it just continues going like NERV today. Right? So you never want to get caught like that. Top ticking is just very overrated. Outside from watching the market and watching interviews, YouTube videos on trading technicals, what are other steps to advance our studying and trading? What are some chop wood, carry water, and trading that we can do every day? So I think that a lot of the strategy that you really need and understanding of the market, you probably already learned it, or it can be learned very easily. The value of more information a lot of times is just like having a diminishing return, if not causing just confusion. Like a vast majority of my time is spent on like self-analysis. So I'm trying to meticulously record the data that I have every day. Like what was my execution data? I'm comparing it to the chart, converting that to R, making sure like the statistics are good, making sure my risk management was good. I wasn't oversized or getting, like I wasn't getting overzealous. How was it? How was my plan compared to what actually transpired on the chart? Like how is my system performing? Can it be optimized? Just a lot of, straight up reflection on executions, in the past I used to like write down a lot of things regarding like, oh, how I feel and things like that. But the problem is that like it's good to write a couple notes down so you can look back, but it's like these notes, they don't matter. They don't make a difference unless you go back and read it. So if you're not the kind of person who'll like go back and read, it's very difficult. But so I do this daily, every day. I check the charts, check the execution, compare it, everything like that, make sure everything's good. And then I'll do a weekly analysis, and then I'll do a monthly as well, of just basically the whole week, the whole month. I just go run through all the executions, all the charts, and just see like, is there any kind of things that stand out to me? Were there any days that I executed poorly, or any days that were outliers one way or the other, good or bad? And typically it's the bad, and then I kind of want to see if I could improve on that, if it's something truly out of my control. And it's important that you don't like overcommit to some optimization that you make for something that happens like very infrequently. So that's where just the repetition of this is going to like matter a lot for your understanding the market. I think the data is really good just because like it's so easy to understand and to kind of compile. So you put those executions together. I put them like kind of in a monthly chart, and then I can see like the averages, and I can pull the statistics I want, like the profit factor, the win rate, average scores, stuff like that. And you can notice kind of trends in your own behavior, performance, the markets. These are the kind of analysis I think is important. After you blow up, how do you mentally humble yourself and set your ego aside to trade the correct size for your account rather than oversize? Getting used to making X money, then sizing down to a slim fraction of that is a challenge, I imagine. Yes, it is, but the thing is, when I blew up, I was doing that. I was already doing the position sizing correctly. It was just a matter of like, it was literally like 1 to 3 trades. I think it was 2 or 3 actually, where I just kind of lost control, and they were very like close to each other. So, you make one mistake and it can snowball in terms of like getting bailed out into a big win and like trying to risk more, even though it wasn't earned. That's like a big no-no. So basically what I did was I reduced my trading percentage down from 2 to 1. And in fact, like I was pretty much at my like financial end in terms of like that's all I had. So I trade very seriously, and pretty much it really depends on your mentality. It's like if you really treasure your account, then you're going to do whatever it takes to keep it afloat, right? Because the worst case scenario is you're not trading anymore, and if you're not trading, you're not getting experience, and you could just kind of throw away all the effort you put in. So for me, like I already understand a process that works. I've kind of experienced it prior, so it wasn't difficult to be humbled. I will say it's just more of a matter of like, what is your kind of breaking point in your mentality to the point where you are just willing to do everything right. And there is one anecdote where, so once I restarted my account, I focused on my best setup, but I had a little bit of like a good string of trades, and I was feeling confident again. I started taking like B and C setups, and my performance suffered. So at that point, like even having been humbled, a second humbling was just saying like, look, I am screwing this up. I need to just focus on my best stuff. And from there, that's pretty much from rock bottom, pretty much where you can only go up if you're willing to take the hint. So for me, like the market and your experience and just kind of growing with it is going to be a turbulent one. You're not going to really learn like all too much when you're winning. It's going to come like those big lessons, those big moments of turnarounds are going to come from pullbacks and drawdowns. So, sometimes it's like the bigger the drawdown, the more serious you are. And, that's why it's important to understand risk and ruin and redefine it. Like I pointed out on a tweet like last week, maybe. It's just as you grow your account, just because you don't have PDT anymore doesn't mean you shouldn't define something that you consider disastrous, because like you can't say to yourself like, oh, this will never happen. I'll never lose 50% of my account. I'll never lose like, you'll say to yourself, oh, statistically, if I have this certain win rate, I can only lose, like there's like a 0% chance I'll lose like 10 times in a row. And then you do, and it happens. And all of a sudden, like every stat flies out the window. Now you're in a big hole. Emotionally, you're kind of drained, and like you have to really understand like anything can happen. And no matter how much people want to say like they have a data on everything, it simply is just like at the end of the day, we're playing a game that's like mostly a coin flip. And like I can tell you that like there are traders who literally have all the data in the world. I'm talking like they can pull up any statistic. They can tell you exactly what the odds are, the percentage up, percentage down, whatever. They can tell you every single thing. And these traders cannot trade the market at all. Like some of them quit. Some of them decided to just make programs, websites, or offer services. Like they don't trade anymore. Some of them just trade really small size, and they like to talk a big game about like how their statistics are infallible, and how the retail traders are retarded because they don't use stats. But like I tell you, most of the time they're not really all that they're cracked up to be. So at the end of the day, like if you let that bias you too much in your decision making and your conviction, like you're really putting yourself in a compromised, vulnerable position as a trader. Whereas like if you assume that you're wrong all the time and you do what's necessary to be profitable despite being wrong, that is a better position to be in, just because like it's a more consistent like longevity type approach. It has less reliance on home runs, less reliance on being correct nonstop. And for that reason, like you can focus on the risk management. Whereas like people who are used to being correct all the time, they're very smart, very intelligent people. A lot of times they have a really hard time being wrong, and they will absolutely refuse to be wrong. And we all know, like, no matter who you are in trading, you must admit that you're wrong consistently. So the sooner you develop that sense of like, I really don't know that much, I just know what I can do to impact the market and what I can control, then the sooner you kind of be able to navigate the market in a way that is like, the 1% of traders pretty much. Okay. Noise trades. I have a similar question. How do you go about developing setups and your entry signals? Okay, I'm going to answer this in pieces. I know you asked a bigger one. I do have my screen shared, so I don't know if I should send my DM or not. You can like let me know. I mean, look at the DM that you sent me. But anyway, so how do you go about developing setups and entry signals? So number one, you do not need to create your own setups. There's a lot of setups out there. You need to find like people sharing their strategy or whatever, and like co-opt it. But you got to co-opt it strategically. You need to look at it and be like, okay, what is the pattern they're telling me that they trade? And then you have to look at all the factors, like what kind of volume, liquidity does it have? What are the conditions? What market is it? How can I trade it? And you have to really see for yourself, like, can I put a system onto this trading strategy? So like, let's say you're new and you can literally just copy Kula Maggie's strategy or CanSlim, or it's not like there's no strategies available. Turtle traders even, they publish their strategy, and there's a lot of short sellers also post all their shit. So it's like, don't create your own setup. You want to figure out, like, people trade other strategies and setups, like, and they talk about it for a reason. It's like, it's just something that works. It's more of like an overlay or like a thought process more than like something that they uniquely discovered. I don't think that's really true. Because the markets kind of trend in like very similar ways, depending on like what your niche is and what your focus is. And as long as you can kind of pick up on like what these kind of patterns look like, then you understand. Like, for example, you can look at Mark Minervini. He has a book. He has many books actually, but some of his books, like Think and Trade Like a Champion, there's a lot of examples. He talks about like stage 1, 2, 3, 4, can some traders say like I need to see a stock is trading above 50 moving average, otherwise there's no way I'm going to long it at all. Underneath, maybe I'll short it, etc. So there's conditions, and then there's what you expect to see, and all you can do is really apply the risk and see if you can gather enough experience to believe in the strategy. And once you are able to see what others are seeing, then your job is basically to manage that and then optimize it to the best of your ability without influencing kind of like your you don't want to highlight your weaknesses, you know, like if you're not able to trade a certain way and you're not able to systematize it, or it just doesn't really work necessarily for your health, like you don't not sleeping enough, whatever, like these are things to consider, so you can kind of like optimize it for you. So yeah, just you literally take a setup, that's it. And in terms of entry signal, I'll say like entry signal is not that hard, to be honest. You can use a lot of different indicators, moving averages. You basically just need to narrow down like this, like, okay, what am I looking for? Because you say I'm looking for an entry. What kind of strategy am I trading? Okay, I'm trading mean reversion strategy. So you're not gonna want to utilize like man, there's so many different kinds of names, like there's oscillator, there's like crossover, whatever, like moving averages. You just want to like kind of apply logic to like, okay, what indicators make sense for finding an entry in overextended stock? Like, so you can say like RSI, or you can use moving averages, and you can say like, okay, what is a condition that I can set as a trigger? Like, first of all, what is considered like overextended? What is considered like, you know, a change of momentum? Or you can just literally use time or price action, or you can use a specific type of like candlestick setup pattern. A lot of times trading entry signals become a lot more clear the higher time frame you go. Like, I think the problem people find with entry signals that they fail all the time, because like if you're looking for the shortest kind of entry trigger, like no matter what you find, like the market doesn't really give a fuck if you got an entry signal. Like if you could have an entry signal and it can last like 5 minutes before it goes to a new high, like it doesn't mean that you found the top. It just means you found like an opportunity where the trade will go in your favor real quick. But really the higher you go up in time frames, the more accuracy you'll find. So that's kind of like why people don't find accuracy. And then the second part is like, you also need to be able to kind of capitalize on the trades that do work. And so for most people, they don't really define their price targets. So like a lot of times, you know, they'll take the next like flush or wash or squeeze, and the stock will keep going. And the problem with this is that despite the fact that you found a good signal, you are not like even trading a profitable strategy. So it goes more hand in hand. Like the more win rate you can expect on your profit target, the more risk you can apply, more attempts you can apply. I mean, like you can lose 3, 4, 5 times in a row if you can make it all back in one win. Whereas like if you literally cannot make it back in one win, then you do need to take the trades off much quicker, and you do need to be like, you know, more safe. And so it's a balance really. But I would say like more important than entry, which is very abundant, is just straight up finding a way to like get more out of your trades and get more out of the wins. That should be like, you should find like a decent enough entry signal and like a decent, like on a higher time frame if you can't find a good one, and then like really work on those price targets. Like what's considered a change of trend? Like how can I trail this stock? How can I, you know, identify levels of support on the daily chart? Or do I feel like these stocks fade a certain like percentage, whatever, you know, like these are all like really common kind of ways to do it. But just because it's common doesn't mean it's ineffective. Like it's really common sense. And you can also use time as well. So if you literally just say like, okay, here's my thesis, I'm gonna say like, at the 10 minutes after the open or 15 minutes, an hour after the open, I'm gonna initiate a position or I'm gonna close my position. Same thing like MIC talk about like the 10:30 rule for them. I don't subscribe to that necessarily, but the thought process is good enough. You can apply that to yourself and just kind of like literally just run through it. Like I have a list of screenshots. I say, okay, what the hell happened for the setup on 10 o'clock? And I'll just go through them. I'll say, okay, that one worked, that one didn't work. And you can just build out like a system from thin air. But it's all about kind of like the average kind of result that you tend to expect. And if it doesn't happen once or twice, you can't just give up. You have to really like understand and like have the experience to say like this majority of the time this is going to be effective. So like sometimes you can do whatever, you can try really hard like any RV. You can have waited all day and short the backside and then it will like pull back barely. And no matter how much risk you put on, like it's very hard to make that back. So it's like, are you going to say that those midday trades don't work anymore at that point? Or are you just going to say like, it just didn't offer me the reward and thank goodness I put on the appropriate risk, because like even nailing the trade, like you quite literally cannot make it back. So just things to think about there. And these things are systematic, so you can always test it. Okay, I'll move on. How robust do you make entry signals for day one gaps, as well as often weirder multi-day runners? What have you done besides increasing time frame to make it smoother? Yep, it is really come down to time frame. Like you can't really find a condition that will, I mean, you probably can, but it's very difficult to find something that's like truly high win rate, truly always consistently catching the best entries. I mean, it's kind of like just a dream, I think, because for every like over optimization you make for like, let's say you find one outlier situation where it breaks all your signals, and so you say like, okay, I'm going to tune myself so that my signal is going to be like way more robust against this particular situation than every other situation where, it dies much quicker. Then all of a sudden you miss out on those opportunities, and you have to be able to accept that. It's the reverse as well, where you have the opportunity to get like better entries, but occasionally like you can straight up just max loss out on a trade because your signal is just way too aggressive and it's being manipulated, or there's some sort of catalyst behind it or whatever. And that is also something you have to accept. So it's like, you can't ever really make something perfect. And it's just about understanding that. For the multi-days, it's just a matter of like understanding differences of pattern. Like these patterns are not the equivalent of each other. Like a day one gap is not the same as a multi-day runner. There's a lot more like dynamics at play with the support and resistance built off of prior days and essentially like manipulation at times. So you have to recognize like the condition for those trades are different. And that's kind of like some of the trades I was talking about before, where like when I had to reset my account and I'm like trading all these different setups. If you're trading a multi-day the same way you're trading a day one, then that's essentially like, you're either good at one or the other most of the time as your main, and you have to kind of just drop the other one if it's not working. And that's just a way of like building your consistency. And then once you kind of have the ability to trade, more, experiment more, then yeah, you can do those, but it's just not the same. It's not one-to-one. It can have similar characteristics though. How do you go by re-entry signals? For example, get back right away if it's clear, I'll wait for it to extend again. So that comes down a lot to recognizing like what those resistance levels were. So like there's a very rare situation where I'm going to get back in right away. More often than not, like if that situation happens, then I'm just going to wait it out, because like I don't think it's worth it. However, like let's say you have an improper stop, like you've moved it down with like pyramiding or something, and for some reason hits your stop loss, but the trade itself is not necessarily broken, then at that point it's kind of like those are also points where you can put the trades back on because it's still technically in play. You're just simply managing risk. That's the situation. But yeah, like if you look at NREV today, if you were shorting that and like you said, oh, it's gonna break out in the daily and come right back down, then and you reshort, your risk becomes really unmitigated. I mean, of course you can like risk ahead or you can cut really quickly, but it's like it's a bad habit because the more size you trade, the more difficult it is to get out of those positions. And I know it's like very trendy, but generally like I want to see more out of the price action than like anticipate that it will crack and pretty much slam back down, because it's like when you do that, right? No one is going to just be like, okay, I'm going to put my short 1 cent over high of day and risk like 5 cents. You know what I mean? Like no one's going to just make a huge risk reward play off of that. A lot of times you have to have a wider risk so that you're not exposed to it continuing. A lot of times, like, it was not necessary, basically. Like you can make more by just waiting a little bit extra and having a defined risk level, something to work off. Would you avoid something like NRV, multi-day? I think it's always worth a try, like in those situations where it's kind of breaking out, just because like there's either going to be one or two things happening, right? It's either going to break out for real, or it's going to like people are going to chase it, and then that's an opportunity at times. So I don't think it's anything wrong to trade those. I think where it gets really dicey is when like it's a multi-day where it's following like a higher volume day, or it's breaking out of like a higher volume consolidation already, like, and it's pretty much proving that it's breaking out in the sense that like it's way above the breakout and you're kind of like shorting it still. That's where you can get kind of problematic. The latest examples would be like EAR and BWV. That was last week, I think. Basically, you look at, I posted the daily charts on the super follower list. Okay, we have a ton of questions, but I think an hour's good. I'm just gonna recap like part of the day, part of the feeling of a market, and just wrap it up for now. And I may just reuse some of the questions another day. But basically, I think Monday was really, really hot for small caps. There was a lot of action, and pretty much the following day, like it was nothing mostly. I noted a lot of traders said like, oh, they didn't really trade anything, or they forced something, I think it's important you guys understand like even a lot of really good traders, some of my friends as well, they didn't really trade, or they had a very short day Tuesday. And I think today also it was better than Tuesday, but it's not like amazing, right? So it is kind of trending towards being a little bit slower. I'm going to be a little more cautious on Friday. Just, sometimes even if things kind of set up on Friday, if the week's kind of trending towards like lower volume, lower plays, sometimes they can get kind of illiquid and tricky. And like literally sometimes just covering when there's no volume whatsoever. So that's never a good sign. So we'll really just have to see like what tomorrow brings, how excited the market is. I think it was a good bounce back from Tuesday. Tuesday was absolutely dead. But yeah, like just be aware that like we kind of, if you're a short seller, you kind of want to see a lot more excitement in general. and more shorts spread out over more kind of tickers is better generally. And charts that are like trending multiple days, like if you saw a ticker on Monday or Tuesday, it's Thursday, you see it again, like the odds kind of become worse in a way, or they just it's not ideal, right? Just because of all those support and everything like that. But anyway, so I'm gonna just I'm gonna wrap this one up. I'm gonna work on the recording upload. I'll just put it into the channel when it's done, so you guys should be able to catch that and review it again if you want. And hopefully we can do this every once in a while. But thanks a lot, guys. I know a couple people came in just for this, so I think you'll get a lot of value anyway. All right, peace out.